Interest rates are through the roof, FTX wiped out billions overnight, and yet I'm still sitting here happily spending thousands on these goddamn JPEGs.
Oh, shit.
Here's why. I was around in 2017, and I put in my dues throughout the ensuing bear market. Once NFTs hit the scene in 2021, I was wholly uninterested. I didn't get it. I was able to grasp the technology, but I didn't feel like any meaningful innovations had been made. The why wasn't strong enough. A fucking ape for 100K? Yeah, I'm straight on it. But fast forward a few months, and it all clicked. Now, after spending years being all in crypto, and the past year and a half learning and exploring all things non-fungible, I'm all in NFTs. To be clear, crypto still has its place and I will continue to invest, but I am far more focused on the upside of NFTs, and here's why. The first is regulatory risk. Regulation remains one of crypto's biggest hurdles, particularly regarding security laws. Precedent has been set deeming Bitcoin as property, and rumors have swirled that the XRP lawsuit is leaning in Ripple's favor. Still, the FTX mess will draw more scrutiny than ever. NFTs are a wholly different conversation. Whether it's Basie or Doodles, Fidenzas or Fluffs, most NFTs are works of art first and foremost. Opting for a digital collectible form factor is more of a creative decision akin to an artist preferring to use oil versus charcoal due to their unique properties and possibilities. The key advantage versus crypto is that NFTs are not highly financialized pseudo-shares issued by a central entity. Like artwork, NFTs are still subject to their own kinds of regulations, particularly efforts to mitigate money laundering, insider trading, and rugs, or fraud. Now, if the Loomis-Gillibrand Innovation Act draft bill is any indication, there is a chance NFTs will be treated as commodities rather than securities. Expect for far more clarity here once the Yuga Labs probe wraps up. Less financial manipulation. For many folks around the world, crypto is their best chance at financial sovereignty. Hence, why Bitcoin adoption is so strong in developing nations and why DeFi has secured billions in TVL, continuing to function like clockwork even when central exchanges can't seem to manage their account balances. Still, the flood of private pre-sales at undisclosed prices, 50x leverage trading, using tokens as collateral, and manipulated prices and fully diluted value schemes are all raging red flags for regulators assessing the risk of retail engaging with the ecosystem. NFTs are generally non-financialized assets, meaning the typical degen shenanigans and Wall Street tricks don't work. There's no 50x leverage trading. There's no broad acceptance of NFTs as collateral. Companies don't reference NFTs as assets on their balance sheets. Projects don't create and sell NFTs as a means to fund their treasury. And there are no paper shares of NFTs. Now, yes, there are hardcore mint flippers and NFT traders. Blur's popularity is a testament to this. And yes, it is possible to get leverage on a select set of blue chip collections through platforms like BinDAO, Honey, and even some CeFi folks like Nexo. But this only applies to the top 0.5% of all collections, which most are tens to hundreds of thousands of dollars to purchase anyway. 99% of people will never participate in this kind of NFT financialization, meaning one less attack vector for overzealous, underinformed regulators. More transparency. Though transparent in theory, the complexities of pre-mines, private sales, vesting schedules, inflation schedules, burn mechanisms, etc. mean that most crypto projects are opaque in practice. These dynamics aren't wholly new or unique to crypto, but they can be confusing to the average retail investor, making it harder to assess the risk of investing in a token. NFTs, on the other hand, are far more straightforward. There's no pre-mine ahead of public launch, and allocation limits are stated before the mint even happens, lowering the risk of whales controlling the project from day one. Mint prices provide a clear cost of admission, making it easier to assess the cost basis for early buyers and thus the risk to reward when buying in on secondary markets after mint. There's also less dilution risk because of the effort required to create a new collection versus simply creating new tokens. There's more transparency, which means better due diligence, instilling greater confidence and higher conviction for investors. All key factors for driving a project's valuation higher. Clear use case. Most crypto tokens lack any clear purpose or utility. As such, most tokens are really just attempts to capture liquidity from the market. Nothing wrong with that necessarily, but it makes most crypto a speculative instrument by design. NFTs are very clear in what they're trying to be. A work of art, digital memento, an access pass, a claim on a digital item, so on and so forth. Projects that forego roadmaps altogether are even purer examples of this what you see is what you get approach. Now, it doesn't mean the NFT won't eventually have some semblance of functionality or utility, but at least you buy an NFT knowing its baseline purpose and value independent of any potential appreciation in price. A future beyond Web3. Crypto communities are usually composed of people interested in tech or in speculation. Both are fine, but it's a different energy and feel, much more like investing in a traditional company through the stock market. The innovations may be great, but not much else feels compelling or interesting. NFT communities, though, are steeped in culture, that of their own project, but also that of other communities and projects across Web3 and Web2. This emphasis on culture is vital in helping projects scale from a few thousand folks in Discord to becoming an established fixture known by millions. Now, whether it's events like VCon and ApeFest, or installations from Aku World and Doodles, or partnerships with the biggest brands in the world, NFTs are uniquely positioned to leverage IP to craft worlds and experiences that appeal to global audiences, providing ample opportunity to scale far beyond the small walls of Web3. Stronger communities. Building on that prior point, NFT culture is firmly rooted in community. It's the literal life force for projects. This core tenet means holders are viewed as an extension of the project and the most important stakeholder, amplifying their voices and opinions accordingly. Hence why AMAs, Twitter Spaces, polls, Discord updates, and more are all so crucial for a project's success. The holders serve as a check and balance system, driving greater accountability and communication from the founders and the broader team. When done particularly well, the community acts as a hive mind of creativity and inspiration, pivotal in shaping the project's future with their opinions and feedback. In the strongest communities, it's typical to find people building genuine connections with each other, whether that's through chatting, playing games, or watching movies together. Clearly, you may not want to be that involved, but this level of engagement is what leads to people holding long term instead of flipping the project the moment they see an inch of profit. More upside. Crypto is far out on the risk curve. NFTs, even further. As such, they also provide more upside. If you assume strong crypto projects like Ethereum will surpass prior all-time highs, it's illogical to expect the same for strong NFT projects. Buying at depressed prices now could provide outsized returns as floor prices increase in tandem with the fiat price of ETH climbing. Since most NFTs are ETH denominated, the appreciation potential is far less obvious at first glance. Take a recent acquisition of mine as an example, a Generation 1 ASM brain with almost a year of historical data. The sustained floor for Alter-State Machine has been as high as 4.5 ETH, or roughly $13,500 at the time. But some months pass, some black swans swoop in, and boom, major correction. I acquired one for 0.7 ETH, or roughly $860 when the floor was about 0.69 ETH. That's a 94% discount from all-time highs, squarely within the sweet spot of bear market lows. If ASM regains its all-time high floor, while ETH is at least 3K, that's a 15x return. If I were to clock those ETH gains and then ETH runs to 6K, A conservative estimate, as it's only 25% higher than the all-time high, that would be a 31x return. At $9,000 in ETH, that's a 46x return. Now, this isn't even factoring in possible airdrops that could be noteworthy gains in their own right. Another key consideration is the long-tail value of NFTs. Though there's many factors at play, the main driver of value for NFTs is relevance and popularity, not any underlying technology. Instead of seeing diminishing returns as the tech adoption cycle matures, the most culturally significant collections will see parabolic growth in value as more people seek to own a piece of the project's early beginnings. As projects establish themselves beyond Web3 and start to become globally recognized IP through branding, merch, games, and more, they create a flywheel of attention, further cementing them as cultural staples. Now, this has already happened with Yuga Labs, and I fully expect to see several more collections grow into multi-billion-dollar businesses. I've already started placing a couple of investments with that thesis. I'll be sure to share on this channel with you soon. Ultimately, if you think crypto is going to have another big run, it's likely, damn near guaranteed, that NFTs will have a bigger one. They're further out on the risk curve, they're more sensitive to liquidity injections, and history shows us that the returns are always the greatest in the first few market cycles of a new asset class. First, it was Bitcoin, then ETH and ICOs, followed by altcoins. But now, it's time for NFTs to drive the bulk of the gains. With all the fear and uncertainty in the air, it seems like a prime time to acquire strong projects before the next major run-up. Not financial advice in the slightest, though. I'm just a dude out here shooting shots based on the best information I have, documenting it and sharing it openly and freely with you. That wraps it up for today's deep dive into why NFTs are a better investment than crypto. But this is all just my opinion. What do you think? Are you more interested in crypto or NFTs? Let me know in the comments down below. I would love to hear your thoughts. For more deep dives and insights like this, subscribe and hit the notification bell to make sure you don't miss the latest videos, like my upcoming NFT Master Plan series, where I break down exactly how I plan on making 20 to 50 times or more returns with NFTs during the next cycle. Also, check out our Substack to collect this episode as a free NFT. And last but not least, please share this with someone you know who's into crypto, Web3, NFTs, or any other tech-related investments. You never know. This just might change their life for the better. But that's all I got for y'all today. I'm Sae'Von Springer, founder and managing partner of Native Assets. I appreciate you, and I'll holler at you real soon. Peace.
You niggas ain't cheat me, 2 TV. I'm a real life shot caller, you niggas just shoot at the breeze.